A good afternoon, folks. Monday, March 27th. This is the final week of the quarter. Dan Nathan, this is Market Call. As I mentioned, one on the East Coast, Mountain Time. Who cares? I guess 3 hours behind on the West Coast. The only time zone that matters, obviously, the East. This brought to you by FactSet Financial Data and Analytics, powered by Tomorrow. By the way, subscribe to our YouTube channel. Smash that thing. Why not? In a few minutes, by the way, Carter Worth of Worth Charting will be joining us. Also, we have Ranger Hockey this week. Major League Baseball starts this week. I mean, we got a lot going on here, Dan Nathan.
Yeah, and we're in the middle of March Madness. Listen, dude, I feel like we've had a little madness. We've talked about it in the month of March. It feels like, we had this kind of little banking crisis, and I say little in quotes here. But by the same token, we've just seen the NASDAQ just power ahead. And that divergence, I got two trades on, and they're kind of canceling each other out right now. One has been short of the financials, and one has also been short of the tech, the QQQ, the NASDAQ 100, and no individual names, to be honest with you. I just feel like this kind of trade is going to come unwound a little bit. But when I look at like what's going on here today, guy, it's not too often that we see a NASDAQ that's down nearly 1% and the S&P that's up on the day. And that's kind of what we had here. It's led by some of these large cap tech names. And a lot of this, if we bring it back to earnings, okay, this is the end of Q1, the final week of Q1 here. We're going to start focus on Q1 earnings and then forward guidance. There's a lot of calls that all of this kind of, turmoil, as you might call it, in the financials and in the banks is going to basically cause the likelihood of a recession, something that the stock market was not pricing in January. The bond market is now pricing now. We have guys over at Morgan Stanley saying the likelihood of a recession is that much greater, and then an earnings recession. So kind of thoughts on where we started the quarter, and the sentiment was really bad at the end of last year, right? And where we are right now, because it seems about as clear as mud is what the economy and what the markets are pricing right now.
Confusing for a lot of people. I think the rally the resilience in the market, I think, is somewhat predicated on exactly all the bad things that have just happened. I mean, something needed to break, I think, for market participants to believe that, okay, now the Fed's going to come rushing to our rescue. They're going to lower rates. Everything's going to be fine. Risk assets, everything is off to the races because they've seen that play many times before. And listen, maybe that's how it plays out. Maybe in 6 months we'll be saying, you know what? That Silicon Valley Bank thing, that was that put in the short-term bottom. It's been off to the races since because the Fed has our back. Personally, I don't think that's going to play out that way. But right now, I think that's what people are looking at, and that's what people are hoping for. But I'll say this, and you alluded to it, and Marko Kolanovic is talking about it as well. I mean, the volatility in the bond market is unprecedented, and whether or not yields go down, I don't even know if it matters at this point because I think credit conditions are going to be tighter almost by definition, and credit's the lifeblood of this economy.
Yeah, well, listen, let's pull up the chart of the 10-year U.S. Treasury yield. And I think this is kind of interesting. We didn't even bother to draw a line, but if you look at where we are right now, 3.5% down from 4% just a few weeks ago, we're right at that 200-day moving average. We've been back and forth on either side of it over the last week or so, but the volatility in that range has been dramatic. But go all the way back to June of last year, and you see where we topped out at 3.5%. Remember that, guy? And, at any point over the last, call it 9 months or so, we've been in and around 3.5%, right? And so, I guess my point is like, that is to me reflective of, and you've been saying this for an awful long time, of the potential of, a slowing economy. And so I just think that what happened in the banking sector is like the likely thing that pushes us over the edge a little bit. We just had the 200-day, or we just had the S&P 500 chart up there, guy. Again, like, here's one thing, I'll just say this, and you and I keep kind of harping on this. These charts look constructive for all intents and purposes, especially when you consider what the backdrop is of a really important group within the S&P 500, the banks, and how poorly they have acted. And you've seen numerous banks go into receivership with the feds, and you've seen money center banks, like once perceived to be fairly safe, dropped 20% in a straight line over a short period of time. Like S&P 500 holding its 200-day in an uptrend, getting ready to retest, if it will, that downtrend that's been in place for, a year and a quarter or so. Like, it's hard sometimes, and maybe Carter can help us make some sense of this. It's hard to kind of look at that picture and say, that's not kind of, that's pretty constructive. Thoughts there?
Carter will say, and I'll let him speak for himself when he comes on, but he has been saying that although he thinks lower in the S&P, the moves we've been seeing are effectively a pair of twos, and people are going to get themselves chopped up in the meantime. And that's exactly what's going on. I mean, there was a point last week, I think it was Friday, but it might have been Thursday. It doesn't matter, where it really felt like the market was going to cascade lower. And then for whatever reason, it got back on its horse. And again, maybe it's on the back of these perceived salve for the banking industry, and everybody thinks the worst is over. And maybe wishful thinking turns out to be the right way to look at this entire thing. But something I said earlier today, and something I will say here again, is the same group that got themselves on the wrong side of the bond move when yields were exploding higher and the yield curve was going to 110 basis points inversion. There's probably an equal or larger group that have gotten themselves equally offsides as yields have gone precipitously lower over the last couple of weeks. So people are zigging when they should be zagging. So if you're asking, which you are, I think there are more chapters to be written in this whole banking thing. And I think it ends when you see a take under of one of these banks. I don't know which one it will be. I'm not hoping for it, but we have seen this play out that way before.
Well, we're going to talk about all that in a little bit, and Carter's going to actually break out some different sectors within financials that have been affected, at least in the stock market, and maybe have yet to have, any recognition of issues that, like you're talking about, and we'll talk about that in a few minutes here. But let's bring Carter in, because he had a great note on Friday afternoon from the slopes. How you doing, Carter Braxton?
Good, thanks, guys. Yeah, all good.
So, on Worth charting, you were spotty last week. I'm glad that you took a little time, because you deserve it. You are steadfast in the work that you do for your clients over there at Worth charting. But this note kind of caught my eye. But I wanted to start, before you talk about, this is epic. I mean, like, literally, people kind of hold on here a little bit, because for some of us who remember the NASDAQ highs in 2000, for you to kind of run through what you're going to run through and really get back to some levels, at least on an underperformance / outperformance, is really fascinating. Let's talk about this NASDAQ for a second. And every once in a while, you play some games over there with your friends at Worth Charting or your customers, and you'll take a name off a chart, you'll put things upside down, you'll do this, that, and the other thing. If we took the name off of it and everything, and we just drew some, kind of crude lines here, I mean, it's kind of constructive looking, right? This is going back to Jan of 2022, Carter.
Right. So if you could alter one thing, it would make it very constructive. If you could remove the August high, right? So if we had come down in January, as we did, and sort of wallowed in base, and then we stayed down in September, and then October was the actual low, that would have more of a sort of a rounding bottom, a bearish to bullish reversal. But we spiked, right, in August. In fact, spiked so much that the street went bullish, right? In fact, you heard the statistic, never in the history of markets have you retraced more than 50% of a decline, and we had, and not gone on and made new highs, new bull. In fact, it was Zag's opposite. Of course, we crashed from there. But if one could remove that, we would be in a really good position to sort of pop higher. But we cannot remove the August spike, and so there's overhead supply, right? There's congestion, there's stock ahead, as the expression goes.
Yeah, I mean, Guy, again, we talked a lot about how during this period over the last few weeks, just the NASDAQ has been a huge beneficiary. In particular, Apple, Microsoft, even Google rallied like 15%, Alphabet, right, off of those recent lows. NVIDIA just kept on powering ahead. And so when you think about how much of those names are the weight of the NASDAQ 100, I think those top 6 names are nearly 50% or so. Does that make you feel like more constructive? You know what I mean? Like, listen, we're getting into quarter end. There might be some funky marks and all that sort of window dressing sort of stuff. But does that concentration now make you feel better or worse about the chances of this stock or this ETF breaking out and maybe testing those August highs? Because listen, if you're short right now, which I am, that would be very painful. Even if it gets those August highs, you're gonna have to make a decision there.
We've seen, to Carter's point, the flight to quality in some of these high valuation, high growth names. And by the way, I'll throw Apple in terms of high valuation. I mean, it's not ridiculous, but it's certainly expensive. And, that has been the perceived flight to safety, and that can last longer than people acknowledge. But typically that's sort of the final innings before everything starts to capitulate. And we've seen it a couple times over the last few years. But does it make me feel better? Not necessarily. Because right before our very eyes, some of these stocks, which went from reasonably valued, have gotten themselves expensive seemingly overnight. And, I'm reading through the comments, and people might be saying this in jest. It's hard to tell sarcasm in the written word, but, people talking about NVIDIA being the first $5 trillion company. I've seen things like this before at certain stages of cycles, and it typically doesn't augur particularly well. So when Apple and Microsoft are now 13% of the S&P 500, as you mentioned, literally a handful to 6 names, 50% of the NASDAQ, I mean, that's problematic because each one of those companies have idiosyncratic risk, and none of them are without flaws, and some of them are downright expensive. So, yeah, it concerns me a little bit.
And, and there's this, the concentration it's ever thus, right? It's the natural way of things. I mean, think about sports teams are almost always dominated by a player or two. Great political campaigns in any endeavor. In fact, the concentration in Apple and Microsoft now is analogous to AT&T and IBM going back 40 years. And at the time, right, one can never see how the champion could falter. Mm-hmm. What could possibly stop Babe Ruth here? LeBron James, he cannot be stopped. And that there's always something. What this is at this moment, the money flow into, of course, these names, hold aside NVIDIA, but the more mature growth names, Apple, Microsoft, it's literally the face of fear. I mean, it is the most offensive thing you can do besides literally going into soup cans and detergent is going into something that's idiosyncratic in its nature, growth, and it's not responsive or as responsive to cyclical assets in a prospective period of economic contraction. And then here's the irony and real ironies. Forget about the actual names, Apple and Microsoft. Think about the men behind them. It's like saying, I am so terrified about what's coming. I think I'll just put it all with Steve Jobs and Bill Gates. I mean, that's the most offensive thing you could do. And that's what people are doing.
Yeah, no doubt about it. All right, let's take us into a little bit of a time machine. You want to take us back to 2000 here, something that I think Guy and myself and you all have a little scar tissue from that protracted bear market that went from the highs in 2000, 01, 02, really kind of even made a new low almost in 03, right? In early of 03, Carter. And then the shocking thing, and you've talked about this over the years, I mean, how long it took the NASDAQ just on an outright basis to kind of get back to a level that had been much longer.
Sure. But before we look at the charts, I mean, the valuation in the dot-com period was such that Walmart was trading at 40 times. GE was trading at 40 times. So it was excess that was all encompassing, which had its culmination in these dot-com stocks, many of which don't exist. But let's look at the charts. So this is simply, now we're not looking at absolute anything. We're looking at a ratio, one thing divided by another. It's the S&P 500 technology sectors relative performance to the market, one thing divided by another. Now, it doesn't say much here because there are no lines or arrows, but let's put some in. So this is not random. Maybe we can toggle there. Take it off, put it on. I mean, how is it possible? And we got back there just about 10 months ago, and it hit its head to the penny, and that kicked off this bear market. And now we're back there again. Look at the next chart. It's really up close and personal. So we got there literally in the sort of October, November period of 21. Market peaks on 4 January 22, and the whole thing goes pear-shaped. Now we're reapproaching that level. And so if you look at the long-term chart, again, the question is, do we break out here on a relative? But the main thing is, and this is the tragedy, that the S&P 500 technology sector, whose constituents are always changing, has just now recouped all of its relative losses, meaning it was one of the greatest wealth creators, that sector, of all time on the way up, one of the greatest destructors, the dot-com crash, on the way down, and only now, 22, 23 years later, on a relative basis, has it gotten back in line with the S&P. It's a stunning kind of thing. It just shows how important it is not to be in the market when it's really expensive. yeah, stunning. But
no, it is stunning. And what's interesting here is we are on the verge of, you get to conditions that are unsustainable. And to your point, maybe it does break out from here, but a lot of these things become mean reverting. And so, it historically, and you can go back and look the reasons why people flocked into these names. I mean, 98, 99, 2000 is pretty self-explanatory. What we saw recently, somewhat self-explanatory in terms of the type of environment that we found ourselves in. And it's just it's at the crescendo of things. It's not at the beginning. That's my take, at least. When you see something like this, it's not the beginning of something, Dan. It's closer to the end. And in this case, it would mean, I think, that the NASDAQ gives it up a bit, or maybe even more than just a bit in a meaningful way. And today, at least a snapshot of where we are right now, and I'm not suggesting this is a trend at all, but today's action speaks to what it could look like moving forward.
That's right. I mean, we're up against a difficult level as they occur. The one thing, of course, to note is just then versus now, just how much steeper the parabolic move of the sort of 97, 99 was, whereas this approach, obviously not as steep, and we've been backing Philly for the better part of 3 years. I don't recall if we have other charts, but we might. I'm not sure. Oh yeah, I'd forgotten. So this is now, forget about the ratio. This is the sector itself. And what jumps out, of course, is how far above we are from the dot-com peak. But the thing is, it's not that all impressive. So what I've taken there is annotated from the absolute high of the dot-com peak to the high of this current cycle, which was 4 January. And you see there that that's an annualized return of 5.4% over 22 years. That's not exactly a real boom. But what if you take it to the present? So if you do it just simply to the present, actually from the dot-com peak to where we are now all of a sudden your annualized return drops to 4.2. I mean, this is pretty sort of modest stuff. And then if you want to talk about feeble, even worse than modest, look at the next thing. This is the same thing adjusted for inflation, which is to say that if one, unfortunate or not, had committed all of their capital for whatever reason at the peak of the dot-com in the technology sector, and is held to this day, your annualized return is 1.64%. That is bad.
Bad in a word, as Guy would say. And I think the absolute chart's amazing because I remember in 2014, the headlines about when the NASDAQ finally got back to its highs. And, if you looked at, that chart, that long purgatory, from like the mid-aughts to, until it really started going up in 2013, 14, stocks like Microsoft went sideways. They traded in like a 25% range for years, and they remember all the extraordinary or they did the special dividends and that they were trying to do everything that they could, buying back as much stock as they could, and it just wouldn't break out. And it took a period of, a changeover in management, and a whole host of other things. And we saw that around the same time with a bunch of other stocks like Apple too, right? In 2011, 12. So interesting stuff. All right, let's talk about the banks. Let's talk about financials as a sector. You're going to break down a few things. Guy, I just wanted to get your take quickly because we come in this morning and, Citizens First is buying, a bunch of Silicon Valley Bank's assets, and they're doing it at just a level where I think investors are pretty excited. Citizens First is up, or First Citizens, whatever the hell it is up 50%. Okay, right now. So they're buying a bunch of deposits and assets that are backstopped by the regulators, right? And then the stuff that they didn't want, the regulators still have. Seems like a good deal, right? And so that's caused a little rally in the XLF. It's caused a rally in First Republic and some of the other regionals. It's interesting to note that First Republic is only up 10%. It was up 30% in the pre-market, people. If that stock goes down in the day, watch out for the KRE. I would expect the XLF to follow suit. But Guy, your thoughts on all of this, because you've been mentioning this. I mean, they are buying these assets, these deposits, whatever the brand they're getting, out of receivership. Yeah. And so if you walked in this morning and you're saying YOLOing First Republic, and we don't really know what the issues are just that yet, they have not quantified them, you might be buying bad equity here.
Yeah, and listen, if you trade it in the first 30 minutes of the day, good on you, as the Australians say. But there's more to this. I mean, think about it. When was the last time we put that headline back up real quick? When was the last time on Fast Money or on any of our shows we uttered the phrase First Citizens Bank? I'm sure it's a lovely place I saw the CEO on this morning. He was asked questions that he seemingly gave complete non sequitur answers to, but that's neither here nor there. But think about the discount with which they bought the assets, and think about all the other banks that could have stepped up but didn't. So you have to ask yourself, well, wait a second. Maybe things aren't as strong as they appear, and maybe we're not at the end of this thing. Maybe we're just in the early innings of this thing. And I said it earlier on this show, and I'll say it again. I'm not wishing for this, and I don't know what it's going to be, but this typically plays out where you see some sort of take under, not a take over, coming in the form of a stock that closed, let's just say, for sake of argument, at $25, and the next thing you know, it's being taken under at $7. We've seen that before. And by the way, quickly, I mean, this to me is at the beginning of things in terms of what banks are going to do. The credit cycle is going to get tighter by definition, which makes it a much more difficult environment for banks to function in. So I can understand why people are saying breathing a collective sigh of relief, but I think there's just another wave out there on the horizon waiting to crash.
So Carter, we wanted you to take a look. Again, I know that you don't really care about what you call the fundamentals and all that sort of stuff. And oftentimes we had a great, we talked about Square last week, and we kind of gave you a big shout out because I think you've ingrained this into us that oftentimes the technicals are leading the fundamentals. And the day before that short report came out on Square, we talked about it, just the kind of series of lower highs and series of lower lows, the poor relative strength to some of its other peers, that sort of thing. And then all of a sudden, stock's down 20% the next day on a short report. And so, like, I know that is what you do. That is your skill set in figuring those things out. So we wanted you to kind of take a look and say, okay, it started with the regionals. We all were looking at the KBW, the KRE, right? Like that sort of thing. It spread to the kind of the XLF, right? The mega cap sort of names there. We know there's a big insurer in there, which is, well, Berkshire, which is, a large part insurance. And we wanted to just kind of give us some context about where we know everybody's focused, but then also when you look at some of these big life insurers, there's just the weakness there looks a lot like the regionals, right?
Yeah, I mean, it's both similar but different, and we can look at it. I mean, of course, the insurers don't have the same basic risks that these operating lenders do, if you want to characterize it that way. And in fact, on a relative basis, if you take the S&P 500 insurance sub-industry group overall, and of course, there's different types. There's property casualty, there's life health, and it goes on. But insurers generally, it's weakness to take advantage of is my hunch, whereas the weakness in the banks is something to stay away from. That's the S&P 500 sub-insurance group overall, which again picks up things like MetLife versus Chubb versus Aflac and AIG and everything in between. And so it's a well-defined trend line, and it's a break-in trend. But if you were to look at insurance relative performance to the XLF, of course, it's a much different picture. And here and now, I'd rather be in insurance stocks in general than banks, asset managers, broker dealers.
Yeah. So run us through just, what, like if you're still short the XLF here, are you pressing? Okay. That's one question for you. You talked about some weakness to take advantage of versus weakness to just kind of stay away from. I mean, to Guy's point about like there's going to be some other regionals that see their equity go essentially to zero, right? Like that's not something I'm asking you to opine on, but if that were the case, like it may be a little too soon on the regionals. So just walk us through some of the absolute and what you're thinking on some of these setups. Sure.
Independent, just conceptually, right? There is a concept that if something has just gone wrong, right? A hole in the boat, you don't just, you let things, you step back. There's an expression, let the dust settle. You want to assess the situation. Rushing in typically is wrong, right? And some people have 3-day rules. These things, those are kind of made up, but I buy something after 3 days of weakness. But the concept is right? After an initial blow or hit, the stock drops because they cut the dividend unexpectedly or they restate it. It's appealing to jump in and say, this is weakness but there'll be time enough. You first have to figure out whether it's going to get worse. Now, to some extent, we have price discovery. This banking crisis, as we know it, is not yesterday. It's days and days and days now where big portfolio managers, hedge funds have had time to make decisions and move capital. For me, though, it's not weakness to take advantage of. We can look at some of the absolute charts if you want.
Yeah, let's.
All right. Well, here's XLF. I mean, this is a pretty good. I mean, if you think about it, one could say, what crisis? All it is back to where it was 2 months ago, right? Which is kind of the point. I mean, now to be fair, this has Berkshire in it. This has JP Morgan in it, right? This has things that have nothing to do with the crisis at all. Not to say that JP Morgan doesn't, but there is no banking crisis at JP Morgan. So one thing to say is it's back to the pre-COVID level and is basically backing and filling. You could draw the lines another way. And so let's toggle one way, the other way, one way, the other way. It's a pretty big juncture. We're kind of flirting with a break in trend. We're flirting with, and so again, no reason to step in on the long side. The question is, what is the downside? I suspect there's more. Hard to know how much.
Yeah, I'm with Carter on this. We talked about it on an earlier show, Dan, and I think came out a half hour or so ago with Liz. This does not trade. The XLF does not trade particularly well at all. And these levels, if you could toggle back, I mean, we mentioned that the level we're finally holding at here is the same level we topped out at. Past resistance becomes support, and that's what we're seeing here. But the more times, you try it on the downside, the more apt you are to break through on the downside. And I think that's where we are now. There's really no meaningful bounce in this ETF. And as we're sitting here, I think First Republic, which I think opened on the highs of the day around $16.38 or something, it has now as a 13.75 handle or so, and has basically been trading, gradually lower all day. That to me is a bit of a warning sign as well.
Yeah. All right, Carter, before we let you go, I really appreciate your time here. What do you make of, I got Google down 3%. I got Apple down 1.25%. I got Microsoft down 1.5%. Amazon, Meta, all down here. And then we see, just this kind of strength a little bit today. I have the XLF up 1.5%. And like we just talked about, the regionals are kind of well off their highs. If tech were to kind of like literally catch a head of steam and we're going to see the NASDAQ down, and we haven't really had any 2% days in the major indices in a while, right? Like, which is kind of interesting. So what do you think is going to lead to the downside? Or do you think that if the banks and the regionals, and there was like, some sort of headlines that at least puts a near-term floor in them, could they drag the NASDAQ back up? I'm just curious what your thoughts here, because again, we got an NDX that's up 16% of the year, and we got a SPY that's still up about 4% of the year.
That's right. You've got real bifurcation, intra-market, sector to sector, financials, energy at one end, and of course communications, which is essentially tech because it's Meta and so forth, and tech itself at the other extreme. The way to look at it, at least to my eye, is this: the market is unchanged, right? We know this, hence the pair of twos designation from my seat. But one could say, so then the market's neither worse nor better. But actually, the market is worse internally, and here's why. That the ones that are in trouble have gotten worse, the banks, right, energy and certain industrials, and further weakness from 2-3 weeks ago is a problem. It means that money is exiting. And so their position is worse. And one could say, yeah, but the position of tech is better, offsetting that, hence the market being hunch. But tech isn't better. Tech has now gotten more expensive because nothing's changed in tech. Right? Apple's not, its growth prospects haven't changed last 5-6 weeks, and Google, it's simply been a recipient of the money exiting other areas of the market. But if you think about the market itself, SPX unchanged, but the way it's unchanged, the two parts are less desirable. The tech is bid up now. It's quote ahead of itself day to day, while the things that are impaired are worse, and they're worse for a reason. The market structure is worse than it was, even though it's unchanged.
The entire move in tech is multiple expansion. I mean, if you think about it, nothing's changed. I mean, as much as people want to say the growth prospects for NVIDIA have changed over the last 6 months vis-a-vis this AI, I mean, let's just be real here. I mean, I would say 90% of the NVIDIA move is multiple expansion. Same thing with Apple and Microsoft. Nothing has fundamentally changed. And some might argue things have actually gotten meaningfully worse in terms of the consumer, for Apple specifically, and in terms of Microsoft, from the layoffs they're seeing from some of their end users, right? I mean, if you think about who they sell to, I mean, that is not necessarily a robust environment either. So it's not being negative for the sake of being negative. It's just trying to read the tea leaves and put it out there. Rotation is a powerful thing, but you're rotating now into an area that was expensive to start. It's just gotten itself more expensive.
Right. And now one could say, look, that overall is the market cheaper because interest rates have fallen. We know that the PE is 18, right, on a trailing. 1 divided by 18, the earnings yield gives you a 5.6%. Now, 5.6% versus 3.5% 10-year Treasury is a better dynamic than it was just months ago when it was almost 5. But still, these are not cheap markets.
Right. Well, and that's assuming that E
That's correct.
component is, and you know, we are in the camp that it's way too high, which leads us to our next thing. Right. Listen, Carter Braxton Worth, thank you so much for joining us. Check him out at Worth Charting. Guy, what do you say? What's the tagline? Worth Charting?
No emojis, no hearts, just charts.
Yeah,
So
there you
good.
go.
So
There you go, Carter.
almost-
Whenever you want to pay us for that, you're more than welcome to.
Exactly.
The marketing
Or it would pay for you not to have that appear on my website, like a shakedown.
Exactly. All right, fair enough. Thanks, bud. Be safe out there. Okay, Guy, that actually leads us to our next and final sort of story here about, okay, that earnings, right? And what will all of this, you know, like what's going on in the banking sector, the higher cost of capital, the probably tighter lending, you know, kind of situation. And so this was something, I think this was in Barron's this morning, and it was talking about the analyst at Baird. He's talking about the regional banking panic can impact any number of industries, including construction. This is Mig Dobra, who downgraded shares of CAT and URI. We see rising risks for rental construction equipment, and a 2024 slowdown in U.S. non-residential construction was already on the horizon. So they're just seeing this kind of sped up. You look at this CAT chart. I think you called for a double, a 5-year double that we've highlighted on many occasions, right up into those highs recently. Look at this thing. It's holding on for dear life at its 200-day, filled in that gap back to last fall. Thoughts here on the CAT tractor?
Well, now it's, you have to prove yourself, because people will point to valuation and say it's reasonable, but when things like this get cheap, they're getting cheap for a reason, and sometimes that's a reason to avoid them, not get into them. And you know, I don't want to go down that rabbit hole, but sometimes cheap on the surface means that things are about to get very expensive. And if non-residential construction goes the way that this note indicates that it will, Caterpillar's not going to be spared from it. So it becomes from a very relatively cheap stock to a very expensive stock seemingly overnight. So the 200-day moving average, we're right there. It's flattening out. Some might even say we're starting to turn down. You're right, to a certain extent. We filled that gap we have from, I think, October, November. But man, we are hanging on by a thread in some of these names. And if more analysts come to that way of thinking, and if in fact you see this slowdown in construction, do you think Caterpillar is going to be spared? The answer obviously is no.
No, and you make a great point. And I'll just say this right now: current consensus for 2023 adjusted earnings are calling for nearly $16. That's like about 14% year over year on 10% sales growth. And let's just say that's what it comes in at. Okay, and the stock has already come in pretty dramatically, right, from above. What was that, 265 or something like that, down to 218 or so. I mean, you have a stock trading about 14 times, and we just said the trailing, you know, PE on the S&P 500 is about 18, right? So that's, I think, like the 5-10-year average or so. You know, you got a 2.2% dividend yield, they got a big buyback, that sort of thing. So, you know, this is a name where if it were continued to correct, right, and get below $200, I mean, at some point, when it starts discounting the impending recession, like then you want to start dollar cost averaging. But what I don't know what people were thinking just 2 months ago when the stock was breaking out to new 52-week highs and YOLOing CAT tractor there in the because they were happy that we literally just downgraded the outlook from soft landing to no landing when 6 months ago at the October lows, and this stock was trading at $160 and we were pricing in a guaranteed recession. Like, that's not how you trade, people.
No, listen, I'm with you. And again, it just is one of those names. Again, you don't have to necessarily trade it, but I think you should watch it just to sort of gauge sentiment and really what's going on. I mean, this is a pretty important company globally. So just keep a look on that. You know, we mentioned the HYG a number of times. That had a pretty interesting drop today. It hasn't gone anywhere for the last hour or so. And real quick before we get out of here, Jim's asking, Guy, are you still bullish on TLT? I think last I looked, it's 104 and change. I mean, effectively being bullish TLT means you think yields, specifically 10-year yields, are going to go down, which I do. It's going to be a bit of a bumpy ride. I think the TLT is okay here. We traded right up to the moving average. We stopped at it, but Personally, I think yields are going to go meaningfully lower, not for the right reasons, by the way, because things are slowing down and because there's some sort of event, which almost by definition means the TLT goes higher, Dan.
Fair enough. You had a good call on that one, guy, of late. And Carter also had a great technical call on that when we were above 4%. I think you were echoing the same here. And again, I mean, I think on some of these kind of risk assets that seem to be a bit more in tune with kind of the news on a day-to-day basis, they're good ranges. You guys have been talking about trading crude. You've been talking about fading the dollar, right? You've been talking about doing the inverse of the yield move. And I mean, those things have worked out pretty nicely here. So, okay. Well, thanks to Carter Braxton Worth of Worth Charting, guy
from Utah, man.
Yeah,
Jeez.
Utah. You know, you're just over there in Morristown, New Jersey.
Yeah, not nearly as much fun, but Carter is fun. Obviously, I want to thank FactSet Financial Data and Analytics, powered by Tomorrow. They are also our data provider. Big week in all things sports, big week in all things markets. We'll be here for all of it, Dan Nathan. Check us out on YouTube. Subscribe to our YouTube channel. Why not? And if you like it, smash that frickin' like button, because that's what people apparently do, Dan. We will be back tomorrow where it's just the two of us. See you later, folks.
See you later. Thanks, everyone.